Have you ever stopped and really looked at the cash in your wallet? I mean, it's just a bit of paper, right? But it holds this incredible power. Today, we're going to unpack the amazing story of money, from a simple idea all the way to the complex world of credit that keeps our modern economy hum.
It seems like such a simple question, doesn't it? But the answer unlocks the very foundation of our entire economy. Why do we all agree to accept these pieces of paper, or for that matter, just numbers on a screen, as payment for real stuff? To figure that out, we actually need to rewind the clock to a time before money was even a thing.
So yeah, before there were bills, there was barter. Let's jump into that world for a second, because that's where we'll find the huge problem that money was invented to solve.
You see, the biggest headache with bartering is this thing economists call the double coincidence of wants. Sounds complicated, but it's not. Look at this example. The shoemaker wants wheat, and hey, the farmer has wheat. Great. But the farmer wants clothes, not shoes. And just like that, the trade hits a brick wall. It just can't happen.
This is the dead end of the barter system. The whole economy gets bogged down, totally inefficient, because everyone is trying to find that one perfect person to trade with. You can see how this would be a huge problem, right? It demanded a much, much better way of doing things.
And that solution, of course, was money. By acting as this middleman, it just completely smashes the barter deadlock. Now the shoemaker can sell his shoes to anybody for cash and then turn around and use that cash to buy wheat from the farmer. Problem solved. So simple, so elegant.
Of course, what we've used as money has changed a ton over the years. Way back when, it was things that everyone found useful, like grain or cattle. Then we moved on to precious metals, gold, silver, things that were durable and easy to carry around. And that journey eventually brings us to today, to paper notes and coins. But that brings us right back to our original question. A gold coin, yeah, it has value in and of itself. A cow is useful. But a paper note? On its own, it's just paper. So why on earth do we all agree that it's valuable?
The value all comes down to trust. But we're not trusting the paper. We're trusting the system behind the paper. It's authorized by a government, it's issued and guaranteed by a central bank, and importantly, the law says it must be accepted as payment. Our faith isn't in the ink and fiber, it's in the whole institution.
Okay, so we trust the system. Now let's talk about where most of our money actually lives. It's not stuffed under a mattress, it's in banks. And what banks do with that money is what really powers our entire modern economy.
Most of us, we put our extra cash into a bank account. Why? Well, it's safe, and we might even earn a little bit of interest. Since you can take that money out whenever you want, on demand, it's called a demand deposit. But here is the crucial part. The bank doesn't just let your money sit there gathering dust.
This right here is the core business of banking in a nutshell. They only have to keep a small slice of all deposits, say about 15%, on hand. The rest of it, that huge 85%, they loan out to other people. They charge those borrowers a higher interest rate than they pay you on your savings, and that difference, that spread, that's their profit.
This whole system of lending creates something incredibly powerful: credit. But as we're about to see, credit can be a double-edged sword. It can be a massive help, pushing people forward, or it can be a really dangerous hazard, trapping them in a cycle of debt.
So at its heart, credit is just a promise. A lender gives you something now, and you promise to pay them back later, almost always with some interest. Let's look at two very different stories that show how this plays out in the real world.
So first up, meet Celine. He gets this huge order for shoes, but he doesn't have the cash up front to buy all the materials. No problem. He takes out a loan. Credit allows him to buy the leather and cover his costs. He finishes the job, makes a really nice profit, and pays back the loans easily. In this case, credit was the key that unlocked a huge opportunity for him. But now, let's look at the other side of the coin with Swap in this story. She's a small farmer, and she takes out a loan at the beginning of the season to buy seeds and fertilizer. The plan is simple. She'll pay it all back when she sells her harvest. But then disaster strikes. Maybe pests, maybe bad weather, but her crops fail completely. So now she has zero income from her harvest, and there was just no way she can repay the loan she took from the moneylender. Her only choice? She has to take out a fresh loan just to pay off the first one. And just like that, she's caught in a debt trap. Instead of helping her, credit has pushed her into an even worse situation. It's a painful cycle, and it is incredibly difficult to escape.
What the stories of Salim and Swapna really show us is that there are two very different worlds of credit out there, and where you get your loan from can make all the difference between success and total disaster.
It really boils down to the formal versus the informal sector. On one side, you have banks and cooperatives. They're supervised by a central bank, which makes sure the terms are fair and the interest rates are reasonable. But on the other side, you have unregulated moneylenders. There's no oversight, interest rates can be sky high, and the terms can be totally exploitative.
And the reality, especially in rural areas, is pretty shocking. Just look at this. A full third of all loans still come from moneylenders. And when you add in the other informal sources, you realize that half of all rural credit is coming from this high-risk, unregulated world.
And even in cities, there's this massive divide. 90% of rich households get their loans from the formal sector, the ones with lower rates and more protections. But for poor households, it's only 15%. They're often shut out because they don't have the collateral or the paperwork that banks demand. So this creates a huge challenge. The people who would benefit the most from cheap, fair credit are the very people who have the least access to it. So how do you even begin to fix a problem like that?
Well, one really innovative and powerful answer is the self-help group, or SHG. The idea is simple. A small group of people, often women in a village, all pool their savings together. Then members can take out small loans from that shared pot of money at a very low interest rate. And because everyone in the group knows and trusts each other, there's no need for collateral. It's an amazing tool for building financial independence.
At the end of the day, it becomes crystal clear that whether it's Salim growing his business or a farmer just trying to buy seeds, access to affordable credit isn't just a personal finance issue. It's a cornerstone of economic development for an entire country.
And that leaves us with one last big, powerful question to think about. If we really want to unlock a nation's true potential, is the most important first step simply building a financial system that truly works for everyone? I'd love to know what you think. Thanks for joining me for this one.